What's up, everybody? It's Austin here. It's Friday. Happy Friday. The inflation report came out. Inflation was hotter than expected. The market's down. My portfolio's down 6% today. But I'm going to share in this video why I'm more bullish now than I have been before. This is about long-term investing. If that's what you're doing, if that's what you want, you're going to love this video and you're going to love this channel. All right, here's the headline. CPI surges 8.6% year over year in May, stronger than expected with energy prices soaring. You've probably seen it by now. The market is down. This report came in hotter than expected. May consumer price index plus 1% versus consensus of plus 0.7%. So that's bad. It came in hotter than expected, and plus 0.3% prior. Prices for shelter, gasoline, and food were the biggest contributors after declining in April. The energy index rose 3.9% month over month, with the gasoline index increasing 4.1%. My take on this, the economy and inflation and everything, even for economists, people that specialize this in that stuff, is hard to predict. On top of that, how the stock market is going to react to it is hard to predict. What is baked into stock prices? How much is the Fed going to raise rates? How is the market going to react? Nobody truly knows. People have predictions, and some people will be right, and you'll see that in the news. But what you don't see is all the people that are wrong about everything else every other time. And so as investors, as an individual investors, what can I control? I'm not an economist. I'm not good at predicting the macro economy. What I'm good at is managing my own finances, our family, keeping our expenses lower than our income, and then saving some every month. That's what we're good at. That's my buffer. And then we have a portion of our money that we put into investments. And so if my portfolio goes up or down or whatever, it has no impact on our family life. And so that's what long-term investing is about. And I think if you want to be successful in the stock market as an individual long-term investor, somebody that's not focused on the market all day, every day, I think this is the way to do it. That's just how I do it. A friend of mine, Brian Feroldi, he's also a YouTube creator, got an awesome channel and awesome Twitter, posted this tweet. There's always a worry in the market. There's always something to be scared of. In 2012, it was the fiscal cliff. 2013, a government shutdown. Ebola, Brexit, the election in 2016, 3 hurricanes in 2017, 2 government shutdowns in 2018, impeachment in 2019, COVID-19 in 2020, the attack on the Capitol, supply chain issues in 2021, and then inflation and war and a bear market. Those are very real things, but over that entire time, that 10-year period, the S&P 500 is up 265%. The way that you get those returns is by investing and saving and adding over time, not by trying to jump in and jump out, at least not for me. So that's a little bit of perspective. We always show the portfolio here on the channel, 51,643. We're down almost 6% on the day. If we go back to all, we had made a lot of progress back. We were only $8,000 down, and now it's jumped back up to 15,000 down. We're down 15,000. We put $66,999 in, and here are the positions in the portfolio. Just like usual, I haven't sold anything. So Crowdstrike still the top position. Datadog, Snowflake, GitLab, The Trade Desk, Tesla, Rocket Lab, and Cloudflare. Okay, back to the tweet about Brian about fears in the market. And so what we're looking at here, this top chart is the QQQ, that's the tech index. The bottom chart is the SPY, S&P 500 index. And what we're looking at is percent off high. Right now, for the QQQ, we are 28% off our high. For the S&P 500, we're at about 18% off the high. And you can see that since 2015, this is pretty much the worst drop in the QQQ, even when you take into consideration COVID. And for the S&P 500, since really 2011, 2012, this is the second worst drop. COVID was a little bit worse for the S&P 500 because they have stocks that were more impacted by travel and the economy shutting down. Could the QQQ go down more? Yes. The point is that this is normal. The S&P 500 could also go down more. This is normal. They did get a little bit expensive, but even over this time, with how crazy things are, this is since 2000, if you would have put $10,000 in, really it's since 1998, 1999, which is prior to the dot-com crash. If you would have put $10,000 in back then, even with all these crazy drops, and right before the dot-com crash is when that money would have been invested, you've still got $57,000, 10,000 to 57,000 if you put it in the QQQ, 10,000 to 30,000 if you put it in the SPY. Can you make more money elsewhere doing something else? Maybe, but this just goes to show if your time horizon is long enough through the ups and the downs and you're adding over time, the stock market is a great place to invest. So why am I excited about the market moving forward? Let's run through Seeking Alpha. This is not a full review, but we're just going to look at some of the price sales multiples based on future earnings and revenue expectations. Now, a caveat is that these analysts could be wrong. If we go into a major extended recession, these numbers could be worse than the analysts are expecting. But I think over time, great companies persist and do just fine. And so I'm comfortable looking at this. So let's get to it. We're looking at Crowdstrike first up. So consensus EPS estimates. This is adjusted EPS out to January 2025. The forward PE is 69, still extremely high, but they're looking at growing that at 41, 42% per year. So that number would come down. Okay, we're not really looking at the PE for a company like Crowdstrike as early in its growth phase as they are. Generally, these companies are priced off of sales, so price to sales. Through January 2025, they're expected to have $3.8 billion in revenue. That puts them right at a price sales ratio of 10. I'm comfortable owning that. I'm comfortable with that outlook there, because even if the shares go down or flat from here, if they get to 10 and then they can grow revenue at 20% plus per year, you could expect, roughly a 15 to 20% annualized return if the multiple stays the same or even drops a little bit and they're able to grow revenue that fast. That's how that valuation would work. Looking at Datadog, analysts have this one expected out to 2031, but it's only one analyst. So really we're just looking out to 2024. Adjusted EPS still expensive, 67. Yep, people will criticize you. Why would you ever own that? You're crazy. They're right now, but I think over the long term we'll be just fine. But out to 2024, looking at a price sales ratio of just over 10 with 38% revenue growth. And it's not like that's going to fall off a cliff. They're going to continue growing revenue. And so maybe this one analyst, this number is not that far off. But if you look out to 2031, which is a long time, the price sales ratio is down to 2. If this is a high quality business at that time, A, they'd probably be growing revenue a little bit faster than that, and B, they would probably trade at a higher price sales ratio. So I don't think these stocks are crazy expensive. All right, I'm gonna do a little bit less talking and explaining because I think all these situations are the same if I believe they're great companies, which I do. That's why I own them. Could be wrong. But price to sales ratio for GitLab out to 2025, expected to be growing revenue at 35% year over year with a price sales ratio of under 10. All right, we'll take it. Rocket Lab. This one's by far the riskiest company that I own. It could be a straight up 0 if things go catastrophic and they fail. Or it could have the highest upside potentially. We'll see. Out to December 2026, one analyst is out there with their expectations dialed in. They're looking at adjusted EPS of 56 cents a share, which would get it to a forward price sales ratio price to earnings ratio under 8, which is kind of crazy. But let's look at revenue price sales. So not a lot of analysts covering this. It's a tough stock to cover. It's extremely risky, but out to December 2024, 54% revenue growth. That price sales ratio would be 4. And then this is the point about, companies that can continue to grow their revenue. If they grow at 65% that year, then you're looking at the following year, 2025, a price sales ratio of 2.5. If this is a high quality company with a proven business model at that time and they don't have catastrophic failures and crashes and things like that, and they're growing revenue that fast, I would not be surprised if it has a price sales ratio much higher than 2.5. That's why I own the stock, is because I'm willing to take that risk for the potential upside. All right, now we're looking at Snowflake. So Snowflake's a fast-growing business. I've covered it in previous videos, but analysts have revenue estimates all the way out to 2032. It's only 2 analysts, with their expectation out for that time. But even if we come back to 2025, we're looking at analyst expectation of $4.58 billion in revenue, putting at a price sales ratio of 9. Management has come out and said, Snowflake management has come out and said, I believe this is in January 2029, could be wrong. They're expecting 10 plus billion by then. So analysts are actually a little bit ahead of that. We'll see what actually happens. I think management's being conservative with their long-term target number as well. But through January 29, if they're able to hit 15 billion in revenue, you're looking at a price sales ratio of 2.85 while they're still growing revenue at 25%. Again, I could see it being higher than that. All right, Tesla, everybody's favorite stock to either love or hate. They've got this one projected out through 2031, but it's only one analyst. So let's go to 2024, 25. We're actually looking at earnings here in the forward PE, but on a EPS estimate of 1940 in January or December 2025, you're looking at a forward price earnings ratio of 37. If we're looking at price sales ratio through December 2025, on 156 billion in revenue, you're looking at a price sales ratio of 4.75. And then obviously those numbers, they keep growing. Those numbers get lower and lower in terms of multiple. All right, the trade desk, last one we'll look at in the portfolio. Looking at their EPS estimate through December 24 of $1.56, that brings it down to a forward price sales ratio or a price sales ratio that year of 33. Expected to grow again by 30 to 40%, bringing it down to right around a price to earnings ratio of 24, with expected earnings growth of 30%, right around 30% or 25% plus. So that PE ratio continues to come down. Price sales ratio, again, looking at under 10 by December of 2025. So these are expensive now in terms of price sales ratio, but if the businesses perform, those price sales ratios come down and these stocks aren't that expensive. Why am I okay with this? So this is fast graphs. We're looking at Salesforce right here, and we're looking back to 2007, so right before the 2008 great financial crisis. Share price was $16 a share, and the price to sales ratio of Salesforce was 10.86. Fast forward 15 years later, we're looking at the price of 187 and a price sales ratio of 6.5, down from 10.8 back in 2007. The price sales ratio is 6.5. Somebody that bought it back then and held, that was right before the great financial crisis, through COVID, through this drop right now, they have made 1,000% on their investment for an 18% annualized return. That turns $10,000 into $116,000. When I said I was excited, this is why I'm excited. I think we're getting great opportunities to invest in quality companies if we have a long-term time horizon and things in our personal lives situated where we're not taking excessive risks, we're living below our means, we're not using crazy options and exposing ourselves to too much margin and leverage and things like that. If we're responsible and we're able to save over time, these are the types of opportunities that I think we're getting. And so this drop in the market it's a great opportunity for people that are early in their careers, going to be saving for a long time and want to be invested as a lifelong investor. Another company, ServiceNow, back in 2014, so this is just 8 years ago, a price to sales ratio of 20. So a $10,000 investment back in 2014 has turned into $74,000 today, even after this crazy drop of the stock. That's 642% return for 27% annualized when the price sales ratio dropped from 20 over that time to 15. Why did that happen? Because these businesses are leaders and they've been able to grow their revenue fast enough to make up for that drop in price to sales ratio. The revenue growth is what caused that drop in price sales ratio. And that's exactly what my thesis is for these growth companies that I own. Do I know what's going to happen in the short term? No. Could they go down more? Yes. Are we entering a recession? Probably. What's going to happen in the market? I don't know. What is the Fed going to do next week? I don't know. I don't know any of that stuff, but what I'm trying to do is own the right companies, buy them more and more over time as I remain confident in them and their businesses execute, and then dollar cost average into them essentially and have great life-changing returns over time. If you like that kind of stuff, Please like this video, help people find it. It tells me what kind of videos to make. And then do me a favor and subscribe to the channel and leave me a comment and let me know what stocks you own or what stocks you want me to cover. Thanks and have a great weekend.